Well, I think it's 12:50, Mr. Graba. Let's proceed.
Great. Thank you, Mr. Chair. And Chad is up, and Calvin, I don't know if you're back, but if we can pull up the slides. I think I heard him just coming in the up. There we go. Great.
Excellent. Thank you, John. Thank you, Chair Knox. And thank you as well, Calvin. If we could move one more slide forward. Good afternoon, trustees. Good afternoon, Mr. Chairman. We're on the home stretch of the offsite here. It's been a great discussion thus far. I'll try to continue that. And we will now discuss a fourth strategic initiative. This initiative is to strengthen our influence on fees and cost of capital. And the goal here is to maximize returns by minimizing costs and optimizing value. Several of our investment beliefs provide guidance, and I won't read them, but they relate to negotiating fees and considering the merits of passive investment mandates. I personally like the strengthen influence part of the initiative. Firstly, I like that the influence is acknowledged because we have it. At LACERA, we invest billions of dollars in actively managed strategies, and we have influence to positively impact the value that we receive from this investment capital. We want to maximize this value by securing terms and account structures and options that benefit LACERA. Secondly, I like the word strengthen. It implies to me that we need to be active and engaged as we strive to optimize the value received for our invested capital. Being active certainly means negotiating investor-friendly terms, and it also means shaping account structures that provide benefits to LACERA. I'm excited about that. And being engaged means considering the best option among multiple similar alternatives as we build our portfolio. The subsequent slides are going to provide additional details in similar format. And Calvin, if we could move to slide 31. Here we'll discuss some accomplishments and ongoing efforts, as well as context. And I'll start with our functional portfolio framework. This morning, Esme Delbolske touched on this, and it applies here as well. By grouping together investments with similar objectives, we can better consider alternatives across the options. For example, in the functional category of real assets, we consider how best to get inflation protection. And we evaluate a handful of different options to do this. These options include traditional real estate, infrastructure, and commodities. Again, we want to maximize our cost of capital. Separately, we have established several revenue sharing agreements in our hedge fund's emerging manager program. These are firms we help launch, and as the investment firm collects management and performance fees, LACERA will receive a portion. This is strong alignment of interest, and it's great value for LACERA's investment dollars. Next, let's talk about fee structures. Our most recent hedge fund investment had a management or performance fee structure. With this, we pay one or the other instead of both management and performance fees. Separately, we've had success negotiating hard hurdle fee structures in illiquid credit, and we'll continue to do so. As a reminder, we designed this fee structure to ensure that LACERA would not pay a performance fee just for mediocre performance. Using investment jargon, the hard hurdle structure means we would pay a performance fee for alpha, but not for beta or the generic market return. We want to reward great performance, not mediocre performance. As was mentioned this morning, David Chu and the private equity team have built a successful co-investment program. David Chu is quite modest, so I'm ready to call it a success. However, the co-investment program is an example of strengthening LACERA's influence on fees and cost of capital. It's intentional, it's working. Additionally, within the private equity program, there was a secondary sale several years ago. And this has allowed the team to maximize future value on investment dollars, again, strengthening our influence on fees and cost of capital and the outcome. And the context and evolution items on this page include fee analytics and fee reporting. We've improved in this area, and additional enhancements are in our future. We're also aware that potentially our best way to influence fees and cost of capital might be to choose passively managed mandates. And we're very willing to do this, especially in parts of our portfolio where low-cost investable benchmarks are available, as in the public markets. I'm pausing here to invite any comments from the larger group before we move on.
A quick question, Chad. I know we're going to talk later about, some of our peers and obviously these other entities looking to place significant investments in different places. Does that create more challenges for us in negotiating fees? I mean, is it getting harder to negotiate, generally because of the competitive nature? Is it getting easier?
It's challenging to answer that question potentially in the dimension that you asked it. I'll answer it from the dimension of me evolving my career over more than a decade. It's becoming substantially easier for us to negotiate fees as LACERA, one, gets more sophisticated, and two, uses our size. And we haven't mentioned this yet, but part of our strength and influence comes from our size, right? We being LACERA, over a $70 billion plan, we don't have to accept terms. We don't have to ask managers to consider different terms. We can instruct them that we are LACERA, and these are the fee structures that we're building in our portfolio. And if managers aren't interested, there's dozens of others that we can speak to, and we can shape terms. I'm not finding it harder over time. I'm finding it easier. And the more we have successes, it's like a wildfire, or potentially a bad example, but successes breed additional successes. And I'm finding it easier over time. I think there are numerous things to point to of recent successes, and I think there will be even more in the future.
And I get the size. Speak to the sophistication. What do you mean as we, get more sophisticated? I mean, is that the experiences of our staff? Is there some, technological advantage we have now that we didn't before?
Yeah. All the above. And I'll add to it sophisticated benchmarks that allow us to measure not only if a manager performed X absolute dollar amount, but how much market sensitivity, how much market beta, how much risk was incurred to generate that return. And we want to make sure that we're compensating managers on a risk-adjusted basis, not just for an absolute number. How much risk were they taking to generate that? Another part of the sophistication is looking at investor profit retention. So historically, fees have been discussed as a management fee for some types of mandates and a management fee plus a performance fee for other types of mandates. And we've evolved to consider it investor profit retention. So if a manager earns a 10% gross return, how much of that do we as LACERA keep? Is it 8 out of 10 or 80%? Is it 9 out of 10? And we've identified cases where existing mandates are, we're retaining, for example, something in the 70s percentile. And we've negotiated new structures where we will retain 80 or high 80s percentile. So we're thinking in a more sophisticated manner. We're communicating and projecting to potential investment managers in a more sophisticated manner. And by adding the portfolio analytics team and then augmenting the way we look at benchmarks and perform portfolio analytics, this has benefited over time.
Thank you.
Calvin, could we move to slide 32? Thank you. And so slide 32 and the next two slides have the results of a poll question. Here on 32, we see that strategic considerations are unanimously voted as the most important variable when making future investments. Strategic investments include things such as portfolio fit and fees and objectives. Great choice. We hear the unanimous trustee feedback on this and we'll proceed accordingly. In the interest of time, could we move to slide 33, Calvin? Thank you. And this question asks if we should consider expanded LACERA's co-investment program, if we should further expand LACERA's co-investment program. The responses are mixed between yes everywhere and yes selectively. Interestingly, no trustee voted to not expand the co-investment program. We hear you, the trustees, regarding expanding this program over time. Of course, the details matter. We collectively need to consider appropriate pacing and next steps. Also, we should consider different parameters that might apply to individual asset categories. Acknowledging that co-investments was discussed earlier today, I'll keep it moving unless I see any comments. Thank you, Calvin. And on slide 34, we have a question about owning a portion of an investment management firm. Sometimes investment managers are referred to as general partners or GPs. Accordingly, GP stakes is jargon that refers to owning a portion of these firms. And this topic can get complex, and the details of individual agreements can vary substantially. Some food for thought is when considering the value proposition of GP stakes, we must weigh the merits of potential increased revenues against potential liabilities that may come alongside firm ownership. And our trustee feedback on this item in terms of poll responses was mixed. I'd like to pause here and invite any feedback. Seeing no feedback, I imagine that this is a conversation that will evolve over time, and we'll be mindful of the sentiment from the board indicated in the poll results. And on slide 35, we see potential future aspirations in blue. These are guided by feedback received from the board over time. And as we strive to optimize outcomes by strengthening our influence on fees and cost of capital, there's several potential aspirations that stand out. We aspire to build investor-friendly accounts. This starts by setting our own terms. We have a great track record building our co-investment program, and expanding our prominence would benefit future deal flow. We're mindful of that, and we're working towards that. The feedback from trustees guides us to emphasize strategic considerations as we weigh the merits of potential new investments and how we present items to the board. That's something that came up today. So we're mindful of that. Appreciate the feedback. And before moving to the next session, just want to say thank you for the feedback over time, and we're listening, and invite any additional comments.
John, your thoughts on where we are as far as fees are concerned, making the progress you would have expected? It's taken us a while to get to this point. We're ahead of what you thought we'd be.
Yeah, I think that Chad spoke quite well and articulately about the efforts that we have underway. I think that we've made progress across every asset category. Public markets, liquid strategies, the savings may be less if you're starting with paying 2 basis points on an index fund. The savings may not be as great, but I would say that we negotiate more than ever as a positive. We look at all aspects of a relationship, including the strategic import, including the governance rights we retain. I would say that some of the, in a liquid credit, some of these structures that Chad referenced, where we have hard hurdles, are fantastic. And this is, continuous evolution, because we're going to be presenting going forward some dedicated managed account relationships where the board approved an RFP a year or so ago, maybe less than a year, to custody some complex assets through a third-party provider, and through that, not pay a markup to a money manager to custody on our behalf through the same provider. So I think that we're making progress, really good progress. And I also think something else that Chad had on the first slide about AB 2833, I think that this is more part of the common parlance and lexicon and discussions now. And the one final thing I'll add just is we're not afraid of our business partners. We view that there are many substitutes for any given partner. And I think that gives us negotiating power and leverage and the right mindset as we approach this important topic.
Yeah, that's a good way to look at it. That helps frame it for me. Thank you, John. Thank you, Chad.
Thank you, Chair Knox. Thank you, everyone. And I suppose it's appropriate for me to pass it to Didier Acevedo, who's going to lead us through our fifth and final initiative.
Thank you. Good afternoon, Mr. Chair and trustees. As Chad mentioned, this is the final pillar in the offsite initiatives, LACERA Tide. It's worth noting that this presentation looks a little bit different than the other ones, as there is going to be a comprehensive Tide update scheduled for December of 2021. Staff is currently collecting attributes and demographic data on managers that we partner with and look forward to presenting a fulsome update in a couple months. But just as a quick recap of LACERA's Tide initiative, the right-hand side shows the 5 dimensions of LACERA Tide. There's internal practices at LACERA, there's due diligence on external managers and vendors, there's active ownership of portfolio companies, capital formation that facilitates diverse and emerging managers, and industry advocacy across financial services. Turning to the roadmap on the next slide, it's worth highlighting a few key points on the journey. From an accomplishment standpoint, diversity, equity, and inclusion has been formalized in the investment policy statement and governance principles. Tide has been elevated and ratified as a distinct and integral component of the investment division work plan and strategic initiatives. That's why we're talking about it today. And from an ongoing effort standpoint, diversity, equity, and inclusion will be its standalone section in the manager scorecard, and we're working on that right now. Further, as mentioned with liquid credit earlier today, LACERA is expanding its emerging manager programs across various asset classes. And this is all in the context that there's been an increased market focus on diversity, equity, and inclusion. And LACERA has also evolved with this focus. We have, through Tide, in an all-encompassing effort, have pushed back on managers that make diversity claims, but don't have the track record to support those claims. If we could please turn to the next slide. Diversity, equity, and inclusion have been a long-standing effort at LACERA, as John mentioned at the very beginning of the presentation. However, Tide was just a concept in September of 2020. It became ratified by the board in March of 2021 and is on pace to deliver the first of what will be annual updates in December of 2021. With respect to diversity, equity, and inclusion, the next page poses the question to the board. Do you think LACERA's diversity, equity, and inclusion efforts should be elevated from the investment strategy and philosophy section of the investment policy statement and added to the investment beliefs? The general outcome voted towards yes. And similar to the ESG section mentioned earlier today, it's worth considering the permanent nature of the investment beliefs. And so maybe it's worth discussing for a minute or two if there are any reactions to elevating diversity, equity, and inclusion within the investment policy statement. Great. So lastly, moving on to the last slide, there are 5 aspirations here, 2 of which we'll touch on today. We believe that effective diversity, equity, and inclusion practices lead to better investment outcomes. Therefore, we must adopt a comprehensive approach as part of our fiduciary duty. And the second layer to that is setting the standard for what is a comprehensive diversity, equity, and inclusion policy. And we think that the 5 dimensions laid out in LACERA Tide is a good groundwork and foundation to build upon. If the trustees don't have any comments here, that concludes this section. But prior to passing it on to John and the board consultants, I just want to say that I personally have benefited from forward-looking organizations such as the Twigo Foundation that have been promoting diversity, equity, and inclusion in the financial services industry for the last couple of decades. Thank you.
Thank you, Mr. Acevedo.
Thanks, Didier. And I think maybe it's worth pausing on this, Mr. Chair, for a second under aspirational considerations. I think this goes back to Mr. Jones's comment when we were discussing stewardship about leading. And I think that we are, through the Tide effort and initiative. And I think that we have gotten some recognition for that from a variety of organizations. But I think that the point is well taken, that when we are leading and setting a standard, we should, and this may go back to Ms. Sanchez's comment, that communicate it both internally as well externally, because that's critical to really accelerating and amplifying our voice. So with that, the next section, we have two presentations from our consultants. The first is a peer evaluation. I think Tim Filla is going to lead off the discussion, and he'll be joined by his colleagues, Steve McCourt and Leo Festino. So Tim.
Great, thank you very much, John. Just to paint a little picture of the background of this, we've done a lot of work with staff and with some other plans on evaluating the peer landscape, and why we thought this was valuable. Clearly, this presentation that you've heard today has a lot of information on the 5 pillars and the evolution and the great work that staff and the board has done on continuing to evolve as an investment organization. All of that was developed with the backdrop of a global pandemic, which shifted the operating environment for the staff and the board. Also, in that environment, we were working on a new strategic asset allocation, conducting multiple structure reviews. LACERA developed its TIDE policy. And to top it all off, recently, staff worked really hard on doing a new investment policy statement, a comprehensive review of that for both LACERA's assets and then the OPEB assets as well. So we thought it would be helpful to just put the periscope up, given all of those things that have gone on and the good work that we've done with the board survey here and gathering this information, and try to tie back some of the 5 pillars to what's going on in the landscape around you. So we looked at a number of different plans. So we focused on plans that were identified in the survey. We also looked at plans within California, and then other plans that are national in scope and have similar assets to yours. None of this work was meant to be deterministic, but really just to be an exploration of what are others doing, are there any lessons to be learned, operating models that could potentially be considered. And again, a lot of this ties back to the survey questions that staff put together and asked of the board. The other thing that I would say before we get into the slides, not all of this is quantifiable. So we wanted to make sure we did quantify what we could, where we could say affirmatively plans we're using internal management, yes or no, and give you those results. But also a lot of it just relied on evaluating documents, policies, procedures that are in place, and sort of bringing it back in a more qualitative fashion. So you'll see both quantitative and qualitative information throughout this. The other important thing that I think is worth noting, we think that LACERA's most direct peers, while you could obviously point to others in the state and various other things, we think that the most direct peers are the state level plans that have assets between 50 billion and 120 billion. So we've denoted those as quote unquote LACERA peers. And the broader group that we explore, we just simply call the universe throughout this presentation. And so with that, I will turn it over to Steve to handle the next couple of slides.
Great, thanks, Tim. And the first slide I'm going to go through is summarizes the survey results on internal management. I'll reiterate and borrow Tim's metaphor of the periscope on this. The point of this presentation is to provide survey information to the board. None of the results are an endorsement of one model versus the other. We, of course, are happy to provide our thoughts on each of these, but the point of this presentation is really just to express existing practices in the marketplace. So from the total universe of funds that we surveyed, which is about 30 funds with assets from 18 billion to 400 billion, a little over 3/4 utilize internal management of some sort today. Of the peer plans, which Tim identified as those between 50 and 120 billion dollars of assets, about 84% today utilize internal management. So the predominance of plans your size are already doing some form of internal management today. Plans that are smaller than LACERA are mixed, about half are and half aren't. We just note that in the board surveys, 70% of the board of investment respondents indicated that LACERA should move to internal management in the next couple of years. Obviously, John and staff have provided a review of the pros and the cons, and this topic is obviously has been and continues to be on their mind as well. And the final thing I want to highlight is that the models of internal management vary greatly within the universe. Several funds invest passively in sourcing their equity and or fixed income strategies. There are some that do some internal active strategies, and a number that do direct private market and co-investments. And the one thing I want to highlight there is your fund on the private equity and real estate asset classes, while it doesn't have the same level of delegated authority, the staff doesn't have the same level of delegated authority as other large pension plans do. The types of activities your private equity staff and real estate staff do are quite consistent with how other funds describe their internal management in those areas. And a final point before moving on to the next slide, having observed this presentation today, we didn't survey these funds on the use of surveys, but I will say nobody out-surveys LACERA, and it's really fantastic to see this level of feedback, transparency from the board broadly. I think clearly a best practice of the funds that we work with to receive broad feedback in sort of an objective, transparent way like this. So kudos for that. If we flip to the next slide.
Quickly,
Yeah, go ahead.
you reminded me of that nobody out pizzas the hut commercial. But I guess, the survey was a point in time, obviously. So looking at, in the appendix, the UC retirement system, 75 billion total assets, 4 billion internally managed. Did you get a sense, just from UC retirement as one example, are they, starting down the road of doing more, from an internal management perspective, or is this just kind of where they're going to be for a while? Any sense for that?
Yeah, I would say the main motivator for all of these plans, and we've worked with several of them that have migrated to managing assets internally. The main motivator is the disintermediation of fees, and so the areas where plans are moving more internally, it probably is less internal management in the way that you've been discussing it with respect to indexes, because as I think John has really pointed out, whatever savings there is by moving indexes internally is relatively small because you're starting with really small basis points. And it tends to focus more on the private market asset classes where if staff has delegated authority, they can be more nimble and quick to make commitments, and strategies and structures that have much lower fees associated with them. Things like co-investments or managed separate accounts with specific managers and creative sort of structures like that. that tends to be the biggest trend right now is trying to minimize all of the fees associated with investing in the private markets.
Thank you.
And if I could just weigh in on sort of the nature of the work that went on behind the scenes here. This was, we looked at over 30 different plans on a global basis. It was all primary research. So we didn't reach out directly to their investment staffs or the other consultants that they work at or conduct any sort of survey within those. So we don't have the detailed nuance of where they might be in an evolutionary process. We looked at, their current meeting documents, their IPSs and other procedure manuals that are publicly available, CAFRs, things along those lines, to determine where they're at, right? So I think the next stage of this would be, can we identify a peer group if we want to explore internal management, let's say across asset categories in more depth? Can we put together a more focused group, ask some of those deeper, more penetrating questions and really get the pros and cons weighed out a little bit better? This was just meant to clearly look around, not be a super deep dive.
Yeah, no, I understand. It's a point in time of what they're doing, but I appreciate that perspective. Mr. Sanchez, I think.
May I ask a question? Thank you. Thank you. Out of the funds that you survey that have internal operation or some of the strategies, how many of those funds provide incentive pay to the staff? I mean, one of the things that early on I learned, and the CIO at the time used to brag about it. He and she, subsequently later, will always, when I will raise the issue of the fees, they will continuously tell me, don't look at the fees, look at the returns. Who cares about fees since we are getting whatever, 20% return on the investment? So, in a lot of that, the argument behind it, among other piece of information that I used to get, is that by not looking at the fees or worrying about the high level fees, it provides an incentive to the managers. For example, they carry interest. It's a huge incentive for the in private equity, obviously. It's a huge incentive for the manager to do as well as they can because the 20% of carry interest grows accordingly. So if we were to move some of the operation in-house, I just feel that we need to provide some incentive, not only from the CIO, but also the principal investment officers. I wondered if you got some information on that.
Yeah, so more anecdotal, because we work with a number of plans that do have incentive compensation. Roughly speaking, if you draw the line at about $100 billion, the majority of the plans over $100 billion have some incentive compensation, and those beneath generally don't. So there's some exceptions in there, but that's roughly where the line is drawn. Incentive compensation for investment staff at these plans is generally an art and not always exactly aligned with investment performance. And so typically incentive compensation has a qualitative component, has a quantitative component. And increasingly the trend with a lot of plans is to move the quantitative component to the total fund level. So you don't have incentive compensation for global equity staff that's focused on beating the global equity benchmark, and a separate set of incentive compensation tools for private equity staff for beating a private equity benchmark. Everybody has the same fund level goal in incentive compensation. So it's incentive compensation is very complex. It creates it both solves some challenges and creates its own challenges as well. And I think those plans that have it would be happy to kind of share the good, the bad, and the ugly that comes along with it. The broader point that I would highlight, Herman, which came across in some of the survey data as well, is clearly if you were to manage money internally, you potentially would, in most cases, very likely, need to attract and retain people with different experience levels and different capabilities than your staff has currently. And so the compensation, whether it relates to incentive compensation or just base compensation, would be an issue that you'd have to address and want to address if you moved in the direction of internal management.
And if I could just add, I would say each of those different models really varies wildly from the different plans that we ultimately looked at, from some that have, like Steve pointed out, total fund level incentive compensation, others that employ more active management, let's say in equities. Those folks may get much more heavily incentivized for performance again versus a benchmark, ranging all the way up to the Canadian models where those folks are really truly paid like asset managers, because essentially they do work for an external asset manager representing those beneficiaries' interests. So the models really vary very heavily within this universe that we looked at.
Well, thank you very
One
much.
thing
That's
that-
very instructive, if I may, Mr. Grable. What I will suggest in terms of direction from the staff, from me, is that if we do decide to move forward in bringing in-house, some of the operations in-house, that we also include a discussion about compensation and whether or not, as Mr. McCord outlined, whether or not we need to hire staff for a different skill level, if I understand that correctly. Thank you. Sorry, Mr. Grable.
Oh, no, my bad. I apologize. I'm not going to opine on compensation. And first of all, I apologize. I've got the sun right here in my eyes. So if I look doppled, that's because of the sunscreen. I will gently push back on Mr. McCourt as it relates to the team here. I think that there are, the investment office has grown in terms of our backgrounds, skill sets, prior experience, and there are many people here who have experience managing direct portfolios, active portfolios, and I don't think that the biggest hurdle for us is personnel. I think that it's having comprehensive systems, checks and balances. I think we have to hold people accountable and have the right performance evaluation systems for them. But I don't think we need a wholesale adjustment or that there's a gate as a result of the composition of the team here.
Got it. Thank you for that, Mr. Grable.
Great. So if we can flip to the next slide, the next item that we surveyed was the prominence of manager selection being executed through delegated authority with staff versus under board delegation. And here, similar figures to the internal management. For LACERA peer, 79% delegate manager selection to staff. It's somewhat bifurcated by size. For plans larger than LACERA, about 90% delegate manager selection to staff. For plans smaller than LACERA, about half do. Somewhat obviously, nearly every plan with internal management also provide staff delegated authority to hire external managers as well. For the plans where the board retains the authority to hire and fire managers, they predominantly work in the same fashion that you currently work, where staff recommends a manager to the board. There's a consenting opinion from a consultant 3 out of the 29 regularly met with managers as part of finalist presentations. So that's consistent with data that we observed in reviewing board practices in the past as well. Any questions on external manager selection before I hand it over to Leo? Great, then I'll hand it over to Leo.
Thank you, and good afternoon, everybody. So the next 4 pages, I'll walk you through those, starting with the staffing. And I think you might expect that when the results seem to be intuitive, you would expect that the higher the fund size of a given public pension fund, the larger the staffing with investment personnel. And so you see a direct and positive relationship there. Essentially that line that slopes upward as you move to the right. And the blue dot is LACERA, which plots squarely on that line. And then you see some outliers towards the top. The one to the rightmost would be CalSTRS, so has higher resources. But then you have to also keep in mind, are they engaging more with in-house management of assets? Are they quite involved in ESG initiatives? So those would be drivers for additional personnel. Others with high ratios of staff to assets include, I think, Texas teachers, Ohio, Wisconsin. And then on the bottom, the ones that have less resources, if you will, than peers for their size, according to this sample set, would be funds in New York and Florida. So those are the 3 outliers to the right and below the line. And if you go all the way to the left, that smallest one there, I believe, is Orange County, which is, again, is also pretty much on the line given their assets and their personnel. So this one is pretty intuitive. If we move to the next slide, we now look at meetings. And whereas the prior chart was a pretty clear, positive, direct relationship, this one is all over the map. And so there was no relationship we could establish from the investment model and the frequency, for example, of the meetings, whether these are monthly, quarterly, or 8 times per year and whatnot. It seems like the duration of the meetings, the frequency of the meetings, and what gets covered at each meeting, whether you interview managers or you make other decisions, it's quite mixed. The one area where there was some consistency is the majority of those plans would just have one single investment committee versus having multiple committees, one on each major asset class or asset category. Other thing that was similar to LACERA included the structure reviews that LACERA conducts on major asset or functional categories. That is pretty consistent with the work done by other large peers in this data set. Moving on, I have 2 more slides. The next one looks at stewardship and ownership rights, and we spent a good time earlier with the leadership from Scott. I think when looking at peers, LACERA to us, it's clearly a leader, and the work that's been done over the past few years highlight all of the improvements and enhancements that LACERA has undertaken. So I think it's quite appropriate to say that it's moved from a passive owner and delegator to a more active and engaged asset owner. And then the last slide, before I pass it back to my colleagues, includes the fees and cost of capital, another area that we spent time earlier today. I think this is an industry-wide, and while LACERA has made tremendous progress, others have struggled, or struggle is not the right word, have pursued similar objectives. Cost is a certain way to improve returns. And so it's no surprise that as LACERA continues to evolve, it becomes more fee conscious and continuously looks for ways to improve on the expenses of running the fund. We discussed earlier, the consolidation of the roster, and that has helped bargaining power, if you will, with external managers, as you have a fewer set of managers to negotiate with and more assets to demand better terms. And also the private equity co-investment highlighted as as a significant contributor to performance and also fee savings. I think you also have seen co-investments in many of the peers. We don't have the data, but it's pretty, I would say it is common that the larger peers that you're looking at have also moved into this space. I think then, Stevie, you're going to handle the next slide. Is that correct?
Great. Thanks, Leo. Highlighting survey results and Tide, we're proud to be able to say and also to be associated with LACERA because of its clear leadership in this area amongst peers. You have for many years ingrained ESG factors and diversity, equity, and inclusion within your investment process. You've thought about the topics holistically, not as component pieces of your portfolio, which we personally feel is the right approach to these areas. And you've done it in a way that is empowering to the portfolio, to staff, and all the stakeholders at LACERA as well. This is one clear area where there's been a lot of progress in the last few years, and one in which I think your peers would be looking to you as a leader, as opposed to the other way around. And then finally, if you turn to the final slide I'm going to cover, there were a couple of comments about the Canadian pension plans, and so we wanted to make sure to address that at least briefly. The Canadians are all often mentioned because they have a bit of a different model on how to run pension plans north of the border. As Tim alluded to before, they are different animals. In essence, the investment staffs of those pension plans are not government employees, they're private sector employees. So they have compensation structures, they have employment engagements, and investment strategies that are often quite different than what pension plans in the U.S. Tend to pursue. And so it's just worth noting that there's sort of a spectrum of how direct, active, engaged staffs are for pension plans around the world. U.S. pension plans tend to be less direct in terms of their investing modes, and have less delegated authority than pension plans in Canada, or for that matter, Europe as well. So happy to talk in more detail about kind of differences in those models, but we wanted to highlight that as part of the peer review as well. And with that, I'll hand it back over to Tim to conclude.
And just before you go there, I would just mention that when I took the accredited fiduciary training through NC PERS last year, that they spent a lot of time talking about the Canadian model, a lot of time talking about performance-based salaries and incentive-based pay and the like. It was interesting to hear about, but yeah, very different than how we do it.
Great, and I think some of that dovetails to the second bullet point on this slide under broad considerations. There's an awful lot of this that goes into considering the life cycle of where a plan is, the overall duration of their liability. Some of those are much more perpetual obligations than where we are in the United States, where we've pivoted a little bit away from these as being current employee benefits and sort of phasing some of these plans out. So the investments and what you ultimately embrace as your model does have to factor in that sort of how long are you recovering that investment? Do you have any risk of some of that investment being stranded? And the same dovetails into internal management as well. A lot of the plans that are in this universe that we looked at journeyed down this road many years ago when investment management fees looked very different, whether it's on the active or the passive side. One thing's been really clear: there's been a lot of fee compression that's happened over the last 20 years. As pointed out earlier, what you're paying is less than a basis point on your passive mandates. So essentially, if you look at that on a dollars basis, you might be talking about $1 million to $1.5 million in fees on your passive equity management program. Does that even justify some of the additional hires that you might have to make, which would be basically essentially traders, right? I mean, you've already invested really heavily in your portfolio analytics and your risk management capabilities. I think if there's one piece that's missing on going internal with equities or fixed income management, is maybe some of those market-facing traders. And that, again, is the cost of that going to be prohibitive versus the risks of it. So I think we have to do some trade-off analysis here. I think the previous presentation that John and company did at I think it was the 2018 offsite, highlighted some of these. But again, we're further down the road, and fees have really come down significantly for LACERA and a lot of these asset categories. So I think the other things to consider is best in class can really mean a lot of different things across all of these different dimensions, right? So there are different political, different regulatory environments that you're going to have to operate in. And as a board, you need to weigh the advantages, but also the costs and the potential risks of delving into any of these additional categories. Again, you've spent a lot of time and resources on portfolio management and risk management capabilities. Do you really want extra layers of compliance infrastructure and various other things that you have to develop to trade public securities? Or are you happy using the present construct and then looking at opportunities maybe in private markets where you might have a little bit more leverage over fees, and continuing some of the good efforts that you've done on the private equity co-investment and expanding that maybe into some of the other private market categories going forward. So I guess with that, we'll pause and see if anyone has any comments, thoughts. Happy to answer any questions.
I have a question. Have you found over time that the private market folks, participants, have been getting worried that there's some plans that are moving the management of those assets in-house? And has that had any positive impact on fee reduction in private markets, or is there the potential it does have a positive impact? We just haven't seen the volume transfer out of those markets yet.
So the when pension funds talk about in-house management of private equity assets, they tend to be talking about having delegated authority to commit to funds, co-investments, and other structures. I'm not aware of any other pension plans at any scale that invest directly in companies the way a private equity investor would. That being said, so far
Can I just stop you there? Haven't there been some models, and maybe just been talked about, where one or several large plans would consolidate their allocations to private equity and set up their own kind of legal entity that would do the investing?
Yeah, there's been a few attempts at starting clubs for larger investors. There's been a few transactions that have been executed with a handful of large pension plans, but it's not spread widely at scale as a meaningful investment model for groups that model is challenged with a lot of governance issues around managing the club of limited partners that all have different views, perspectives, et cetera. But what is changing really, really rapidly, and LACERA is part of this trend on the private equity front, is larger investors have, in the last several years, recognized the significant fee savings that's afforded to them when they do more co-investments with general partners. And so far, the way the private equity and co-investments, of course, for the most part, are nearly free of management fees and often carry as well. And so the way that the private equity industry has viewed that so far is sort of a backdoor way of lowering their fees. Private equity doesn't want to move away from the 2 and 20 model that quickly. It knows it has to, and so the way it accommodates larger investors is it provides them more access to free co-investments, which on a blended basis reduces your fees significantly. So that's happening at scale. So far, you've not seen a huge pushback from the private equity industry. As long as they keep raising larger funds at 2 and 20, they're happy to give away the co-investments. And so for the near term, investors are benefiting from lower overall fees than they otherwise would without co-investments. And so in that sense, I think LACERA, even though technically LACERA is not directly investing in private equity under these definitions, because it doesn't have delegated authority in most cases, it's really, LACERA's private equity program is taking advantage of the same opportunities to invest creatively and at lower fees than some of the larger plans are that do have delegated authority.
Thank you very much for that. I appreciate it.
Mr. Chair, would you like us to pause for a couple minutes, or should we keep going through the next section? After this is the last section before a conclusion.
Unless there are any objections, I say we plow forward.
Keep going. Full steam
Great.
ahead.
All the way to Canada.
All right, all the way to Canada. The next section is geographic exposure. So it's to Canada and beyond. Thank you to our friends and colleagues at Makita. The next section will be led by James Walsh from Alborn and Jose Fernandez from Stepstone. And they'll talk a bit about geographic exposure. And we asked them to lead this section, given that both firms are global firms.
Thank you, John. Thank you, Chair Knox and members of the board. I'm going to kick off. I'm going to do about the first half of these slides, and then I'll pass over to Jose to bring it all home. So just to kick off, clearly global diversification, a global perspective is a core belief of LACERA. It's right up there at the top in your investment beliefs. What it says there is that a global perspective gives both diversification and opportunity, and that's the important thing here. The opportunity not just to invest in different things, but also into different economies at different stages of their development, and to get access to structurally different things. And obviously, as investors, what we are trying to do is not just think about where we are today, but as Wayne Gretzky would say, is we want to skate to where the puck is going, not to where it has been. I think the important thing is, whilst we're told very often that diversification is a free lunch, I think when it comes to geographic diversification, it's not completely free. There are risks involved. There are political risks, there are economic risks, and of course there's currency risks. Added to that, there is a degree of complexity and of course additional costs. So we need to think about that. We need to make sure that we're compensated for taking those regional allocations away from a benchmark. And I'll come back to the benchmark, I'll come back to the survey questions in a moment. I mean, I think also it's timely, and obviously as a board, you've spoken on a number of occasions recently about global diversification, exposure to markets outside the US. That's coming up a lot with clients of Allborns, and I'm sure it's exactly the same with Stepstone. It is a highly topical subject to be thinking about at the moment. And we can move to the next slide, please. I think one of the reasons why you've chosen two global firms comes down to the fact that one of your core beliefs is that LACERA is a part of a global financial marketplace, and therefore, in order to access, it's important to have that global perspective. And Allborn and Stepstone together, we have 27 offices across 5 continents, and I'm sure it's the same for Stepstone. Having those offices in different places is hugely important to us, and we have 550 odd staff in those different offices, and Stepstone can talk to their numbers. But having that global presence is really important, not just so that we can operate in those marketplaces, but also that we service clients who are invested in those marketplaces. The next slide just shows your allocation, your exposure at the moment. John presents this on a monthly basis. It shows that you have roughly 2/3 of your exposure in terms of the domicile of that exposure in the US. That's slightly more than the ACWI MSCI benchmark. So you're slightly overweight the US, so slightly underweight the rest of the world. But that's to say you've already got a global benchmark. Moving on to the next slide, and this is where we'll both transition to Stepstone, but maybe pause a moment to get any feedback from the board in terms of these questions. I think the first one asks about the current bias towards the US, and there's a slight majority who wants to maintain that bias towards the US. The second asks about where the board would like to be exposed most, and so it's consistent to say that the majority want to be exposed more to North America over the coming decade. But I think also the board recognizes in the third question that there are benefits to being exposed to emerging markets. So 4 out of the 7 of you spoke about being exposed to emerging markets, 2 to frontier markets. And so I think you're seeing both the desire to be biased towards the US, but also the understanding there's some benefits for emerging markets. So I'll pause there and happily pass back either to the board or let Jose take over. Jose, it's over to you.
All right, so I don't know no questions on this, so we can go to the next slide. So just building on those questions, right? There's clearly, well, maybe not so clear because it's as James said, it's a slight preference for the U.S. Tilt, if you will. Maybe John, you have a better word to characterize sort of where it is, because it's not. I don't like to call it an overweight necessarily, because as you said, it's pretty close to the index, but so that's consistent with the responses from the trustees, where there's clearly a recognition of some interest in other markets, but that the U.S. Having the importance it has. So in terms of why consider the diversification, again, given the responses, I think I don't need to dwell on all of these, but the main reason that we would look at the markets outside the U.S. across asset classes is that those markets outside the U.S. may be growing at higher rates than the U.S. And that higher growth leads to better opportunities in investments, again, across asset classes. Now, one thing you do have to keep in mind as you do that is that some of these markets can be pretty shallow, and the size of the opportunities, the number of opportunities is not as plentiful as it would be in the US or Europe. Clearly, this exposure to high growth markets can lead to positive portfolio returns. And also looking at where is innovation coming from, right? So it's clear the US doesn't have a monopoly on innovation, and especially during the pandemic, we have seen other markets really flourish. I mean, for example, in Latin America, 5 years ago, there were no unicorns, private companies valued at more than 1 billion. Today, as of today, there are more than 40 unicorns in Latin America. So pretty dramatic change. Why is that? I mean, there are clearly companies in Latin America, but same in Asia, Africa, that are innovating in ways that you wouldn't get exposure to if you're only investing in the US. And then, of course, you have to look at each market individually. Each of them is going to be very different. It's going to present very different risk rewards, and you have to look at that again. That's the reason why James emphasized at the beginning the geographic footprint, between the different advisors that you have is pretty vast, and that's going to be really important as you consider these opportunities.
Jose, can I ask you a question about Africa? It's Joe Kelly here.
Yes.
So a couple of years ago, I went to Africa with a fellow trustee, and I had never been before. And the trip was investment focused. And I left Africa wondering why we weren't there. And I say that because it's got 1.4 billion people, 52 countries, a huge percentage of the population is under 15. Yes, it's messy, and it's been messy from a kind of democratic perspective. I think one of the countries we had talked about in depth, its former head of or former star of some soap opera had fled the country, ran to Paris because it had been alleged he tried to poison the former president, and he was now back running for president himself. Well, at the same time, Donald Trump was running for president, so we had a 9-year-old with orange hair running for president. So I think those are somewhat similar. But these countries are young, right? They're basically my age, and we didn't have a representation, and so I just wonder, is that unique in terms of plans like us? There seems to be, I don't want to call it a fear, but just a general kind of hesitancy to look seriously at Africa, and I would have to think that we would do it in the way we do it elsewhere. We'd find really smart people to engage with us, and we'd make some money. Is it absent in other plans as well? And can you speak to the major reasons why it is absent? Exposure, that is.
Yeah, I can start, and James, you can round it up. But yes, in our experience, the interest levels outside the U.S., if you were to rank them, Asia comes number one, and then that's the far and away number one in terms of the attention, the dollars that get invested. And then after that is Latin America. But just to give you a sense, just in private equity, when we look across our client base, if they have allocations to Latin America, it's about 1% of their portfolio, 1%. Africa is either not present in the portfolio or less than 1%, right? And typically, the most common is not present in the portfolio. As to why that is, I mean, I think we might get ahead a couple pages, right? We have a page that has sort of some of the favorable versus less favorable trends, and you will see that, Africa, there's a lot of these less favorable trends. Just on a relative basis, it's been the opportunity set has been much larger in Asia and Latin America than in Africa. I can speak for private equity. In the past, there were very few, I'm talking about 3 large private equity funds, primarily in South Africa, that came to market with great promise and did not deliver the returns that investors expected. I think that set back the market quite a bit. But there's a different cycle that we see now. I think we see other funds emerging there. I think this is an interesting opportunity. I do think you need to have very, people that really know the market, really understand what's going on to select the right opportunities. I also say the fact that there is no Africa-based funds in most public pension fund portfolios in the US doesn't mean there is no investments in Africa. because obviously just, there's multinationals that are doing business there. If you look at private equity, a lot of the large funds have made investments in Africa, in all kinds, from infrastructure to traditional, supermarkets to high tech, financial services, etc. So there is some indirect exposure. It's just if you're talking about managers domiciled there, it's been harder.
Okay, thank you.
Also, if I may, Mr. Fernandez, is that or maybe you did mention it, the development level with regards to private equity that you have in Asia or far behind is Latin America is non-existent in Africa. I mean, I travel as well to Africa because I've been very interested in opportunities there in Africa. And what I learned in those trips is that the development, the private equity development in all the different countries in Africa, right, are not there yet. And then you also have the problem that you got the Anglophones countries, the Francophone countries, so different languages, different laws that makes it more difficult. The other thing that I found in Africa is the fact that a lot of the funds that are present in Africa operate out of either London, US, and some in the Middle East. I personally has been very skeptical in not investing in funds that are domiciled in a particular region. And so that's always been a concern that I also have had in Latin America. Luckily, in Latin America, we have been able to find some good funds there, especially coming out of Brazil. But it's just a lot of work, like everybody's been saying. So it's to go in with eyes wide open and make sure we find that jewel there that we can partner up with.
Yeah,
To
and
build on, hey, Jose, can you
Yeah.
talk to, it relates to Mr. Kelly's question and Mr. Santos's follow on to that is currency. What currency are African funds typically domicile or operated with?
Yeah, historically, the currency has been it's more common. I think, as Mr. Santos mentioned, a lot of these funds are people move to London. So most of the funds in Africa have actually the currency has been the British pound. That tends to be the most common. They typically have a parallel fund structure, whereas for local investors, say in South Africa, they use the South African rand, but for international investors, they use the pound. So as a U.S. investor, typically they don't structure them in dollars funds. So you would be taking some currency risk, but it would be major, a British pound, not a local, country-specific currency in Africa.
Mhm.
So so the currency risk is less pronounced than it might be, if you were investing in those local currencies. You are taking still the political risk, and Mr. Kelly alluded to some of that, which you take, of course, and we'll talk about that in the next slide, in China or other places as well.
In the US.
US. Yes.
Thank you.
Great. So we can go to the next page. We talked a little bit about the home country bias, and I think this also addresses some of the question by Mr. Kelly. Why maybe some don't invest in some areas. For U.S. pension funds, as you all know, your liabilities are denominated in dollars. So taking that currency risk, it's something that most pension funds, will do, but in a very measured way. If you look in comparison, endowments that don't have the issue with the domestic liabilities and therefore are more willing to take more risk there. There is less of a home country bias in most endowments than there is in the pension funds. But again, that's I think a structural issue. If you were investing outside the U.S., right, you're taking risk and you want to be compensated for that risk. And we talked about currency, political risk, and other complexities, operational, right? We talked a lot today about internal LACERA controls and operations. Part of what you do as well when you invest with a manager is what are their controls? How do they manage their operations? That's harder to monitor when the fund is in Asia or Latin America or Africa. You have to take that into account. U.S. assets have tended to be a safe haven, and they tend to do well in a crisis. So to the extent that a crisis happen and you have a home country bias, that can be to your benefit. However, when we talked about the benefits of global diversification, it's not a free lunch, as we say. It's not a panacea, right? The fact is that U.S. equities have outperformed over the last decade. If you look at any time period within the last decade, clear outperformance by U.S. equities. So that home country bias that you have today has benefited LACERA. And then correlations between markets have tended to increase. So, again, even in a crisis, when you might expect some countries to do perform better than others, that has not always been the case more recently. And there's a lot of correlation. If the markets in the US are going down, all global markets are going down. If all global markets are going down, the US is typically going down as well. So the correlation, does mute some of that advantage of being geographically diversified. So if you go to the next page, just wanted to talk specifically about China because we know in the past, we have LACERA has investments in Chinese managers, Chinese equities, and there's been discussion about this at the board level in the past. So I'm sure everyone has seen the headlines in terms of China very recently taking a more hardline approach to regulatory approach to certain sectors of the economy. That has particularly affected a number of listed companies in the US that operate in China, but also private companies in China, right? And this is the perspective we get from our office in Beijing, where we have about 20 people and 2 partners. And, just to give you a flavor of what we hear from them who are on the ground, right? Why is this happening? I think the key is that China has remained committed to opening its economy to foreign investors. They want to have foreign capital to fuel the economy, but they do not want to give up political control, right? So they're trying to balance this desire for foreign capital, but without having to change any of their political structures or political control. So really important when you're investing in China then to take into account, well, what are the areas that could be affected by this view that the government has, and which areas are going to be less affected and can still thrive under this type of environment, right? We think that the sectors that have been impacted the most, which will continue to be impacted, are some areas in the financial services sector. As I'm sure you've all heard about the fact that China really does not like decentralized finance, right? So anything to do with cryptocurrencies, Bitcoin, etc., because that can take some of the control away from them, right? That's pretty clear. So they have essentially outlawed a lot of those activities. And there's certain financial services activities that are also potential threat to government control, those are going to be more regulated. Those are going to be more difficult investment environment. The education sector, again, clear why the government might be interested in regulating that. And you know, the headline for any of us that have teenagers, you know, about restriction of video game usage. I wish the government would tell my kids not to play video games because they won't listen to me. But, you know, it is one of those where you first hear the headline and say, well, why, you know, is China not letting kids play video games because they want them to be studying and therefore that's gonna make them a better educated population, etc. What we hear is that that's not really the case. Again, think about why they're doing it. Is the video games are very different today than they were when I was playing them as a kid. That was you know, 30, 40 years ago, video games you played by yourself. It was not a social endeavor, unless, you know, with your brother and sister, that was it. Today, kids play online, and this is it's social gaming. It is just like a social network. And that's why the government has gone after video games. It's not because of the time the video games, or they might, you know, corrupt young minds, etc. It's really because it is a network that can help kids organize and socialize in a way that is not controlled by the government. So again, it all goes back to this government control point. And as long as you find investments that don't threaten the government in that way, you can do well in China, which, as we saw in a couple slides before, is, you know, fast growing GDP, very large part of the global GDP, and it's really hard to ignore from an investment perspective because there's a lot of growth there. I'll share all my remarks. Any questions?
Yeah, Jose, it's Patrick Jones. Thank you very much for this, getting caught up on China. I know I've had a couple brief conversations with John about it, but in the totality, and again, I'm not, as a relatively new board member, I'm not sure what the evolution of conversation has been as a board about China. I know that Supervisor Barger and kind of, you know, I've had some conversation just loosely about it. And I don't know if we have if we've arrived at yet any kind of statement ourselves, you know, just taking into a balance, whether it's the Uyghurs, whether it's, you know, all these other things, whether it's potential military competition, all these other things like in terms of how we're approaching investment in China at this point in 2021. I don't know if without knowing what the history is, have we been more heavily weighted in the past and we've lightened up? Have we kind of maintained a certain, you know, I think we're 2.7% or whatever. Has that been kind of steady? I'm just trying to get a better sense, because I know it's on the radar screen and has been on the radar screen in terms of some of the conversations I've had. I'm just not sure if we have an official position at all as it relates to that particular geography.
Jose, do you want to start, or do you want me to take that?
If you want, I'll let you take it, John. I'll just say within private equity, right? We're very focused. You have investments there. We're very focused on two sectors we don't think are affected and actually can thrive: healthcare and consumer, local consumer within China, and healthcare, which is not just for Chinese population, but, you know, advancements that are helping, you know, everybody in the world. And again, those two we don't see affected by this regulatory environment. That's all. John, you want to take the rest of that?
I think, and once again, I think this is a great topic for discussion, perfect for today, is in effect, much of our allocation is determined by MSCI, various firms that set benchmarks, and then LACERA, in effect, tacitly, even though it's an active decision in terms of the adoption of a benchmark. When the board approves the MSC ACWI IMI, in effect, the board and within that benchmark, the allocation's 4%, 4.4, 4.5, and growing to China. In effect, that is a statement about our allocation to China. To the extent we have an emerging market debt benchmark and a significant percentage of that is in bonds issuers from China, we're making a decision. With that said, and this may be where the alpha opportunity is, to the extent that they're companies that are domiciled in China, and recognizing, I think what Jose was talking about a lot are consumer facing, not government owned entities, recognizing the government is really putting its thumb on the scale, maybe its whole foot or its whole body on the scale. I think that maybe that's where the alpha opportunity comes from, associated with valuations not being pure or proper or right to either underweight or overweight different investments in the region. But I think that the primary decision that LACERA has made about our geographic exposure anywhere in the world relates to the benchmarks that we've chosen. And to the extent we want to switch benchmarks, we probably need to look at, because that then goes back to Makita and the asset liability study, because those are the same benchmarks that they use in terms of the modeling. So it really goes back. It's a complicated answer to a very important question. But I think that the analysis clearly is changing in terms of global political tensions, what's happening in China, the emergence of maybe Taiwan Semiconductor as the most important company in the world, maybe right now. I think that this is, I will pause and see if Makita, Alborn, or Stepstone want to add anything to it.
I think the only thing I would add is just it's quite interesting when you do talk to people on the ground about, for example, some of the things that have been going on in China. They're much less surprised than we are sitting outside the region, because they see the longer context, maybe because they understand some of the politics behind it. And again, that maybe comes back to the opportunity is that there's maybe a misunderstanding because they have a different political system, market system than we do. And therefore people will pull away, go back in, depending on the sort of the winds of change. And actually being able to take a longer term view gives you the ability to create some alpha.
One thing and once again, hopefully someone talks over me soon. I think that we try to ensure that we're properly compensated for the risks we take, or said differently, look to mitigate those risks. So, for example, if we invest in China, maybe the best way to do it is to invest offshore to make sure that our dollars are domiciled not in China, but offshore. I think that there are little things that we can do structurally just to protect our investment, to going back to earlier conversations about operational effectiveness. Look at the financial statements, look at the accounting standards that a company uses to make sure that what you're investing in has a real value, as opposed to, $20,000 per parking space where, it's in a vacant building. So I think that it's really important to look at the operations and the organizations that we choose to back.
In our ESG process, in its broadest sense, is also something we bring to bear on the opportunities in China as well. Do you feel the consistency? Because I think everyone realizes what the opportunity is in China, right? Whether it's alpha or whatever else. But just in terms of the other kind of qualitative things, do we feel that there's a consistency between the ESG thresholds that we maintain almost everywhere else to China as well, or do we make some different allowances in that instance?
I don't know if anyone on the PE team or Scott want to weigh in. My sense is a good example of this is last month when we committed to a company focused on renewables and the components of it. One of the things that we did look at was the adherence of that firm to IMF standards as it relates to mining and, and kind of aspects of kind of just transition in effect. So I think that it should be a consideration. I think that we hope that ESG standards don't begin and end at our borders. But I hopefully someone else, has thoughts that can be constructive to this conversation.
Yeah, John, I would add that we are just getting back in all the information from our managers, Trustee Jones, on ESG. And so we will be looking at those results and grading the managers over the next couple of weeks. And you'll hear about that in December. And I'll also, jump on the comment by Jose. We have focused on those areas, and we were told this early in our investing in China to have our managers focus on areas that wouldn't be considered a threat to the government there. And so we have purposely stayed away from those. We were advised by one of our venture capitalists over there. She was in the Army or in the armed forces in China, so she is well aware of the pitfalls there. And so we've been very careful in our commitments in that space so that we would not have the type of issues that, while they're not there now, could come forward or come forth. But we think we've been very thoughtful in our process there, and we do think it's a high growth area. And so we will take shots. We're not betting the house on it, but we have been rewarded with our activities there so far, and we'll keep a watchful eye on it like we do all of our managers.
Thank you, Chris. I'd love to take a look at that whenever you get through with the manager evaluation through that lens. That'd be appreciated. Thank you.
Sure.
Yeah, I agree with Mr. Walsh. That when I had the opportunity to meet our consulting partners, in particular private equity StepStone, the last time I was in Asia, I had the privilege to meet with one of the partners there from StepStone who lives in Beijing, and I agree with Mr. Walsh. I mean, the way he described it in his views, political views, and investment horizon is different than what I read here in the newspaper. Quite frankly, I have been scared, especially lately, of investing or continue to invest in China. And I'm not advocating that we get out of China because it is the second largest economy in the world. There's tremendous opportunities. Yeah, but I think perhaps, Mr. Grable, in the future, it will be, especially through this medium, through Zoom, that maybe we can invite some of our partners in China to talk to us and be able to have this frank discussion with them, because they work for us, obviously. And I believe that what you hear from them, some of the issues that we hear here that scare me, it kind of relax me a lot more. So it's something that, Mr. Grable, perhaps we should do that in the future, to be able to listen from people who are in the region, China in particular, so we can have some of those discussions. Because I think it's important for all of us not only to fully understand, and my fear over the years has been that some of my colleagues may decide to vote against a particular investment opportunity because out of fear. So I think it's important that we educate ourselves and go and continue to work in the region with wide open eyes and making sure that we ask the right questions as Mr. Wagner mentioned that we make sure that we stay away from areas that we know it could be problematic in the future.
John, you have a comment? Yeah, yeah, no, I was gonna say our team would be happy to participate in something like that. So I'm sure we can talk to staff about it. And I was gonna make sure I give credit to Mr. Grable for the analogy of the video games. I know he first commented on that to the board. I think the last board meeting. So that was a very insightful comment there. So I think that's really, the one other thing I wanted to add is on the private equity side too, you know, every underwriting for any manager we do includes a component of ESG and operational due diligence as well. And both of those are consistent across all geographies. So we don't make any allowances for a fund that is in Asia or Africa or Latin America. It's the same standard. And it is true that that can be difficult to meet sometimes for some of these funds, but that is, you know, we do think that is part of our job, is to point out to LACERA if they're not meeting the same standards that we are holding a U.S. manager to. You may decide to invest, but you want to know what is different and why. Well, if there's no other comments on China, we can go to what you have all been waiting for since 8 a.m., which is the last slide of this very large presentation. And you can see here, I think we've discussed a lot of these already. And thank you, trustees, for the engagement. Really appreciate the comments and the questions. This is exactly what Mr. Grable asked James and I to try and do, was to elicit some commentary. So thank you for doing that. And I saved for this slide, trying to be provocative. You can see I put a lot of red around South America and Africa, hoping that if I had no comments before this would elicit some comments. But you can see, you know, the big areas that you know you should be focused on, and I think again this is obviously true across different asset classes. This particular one, since we put it together, is more focused on the private markets and what Stepstone's opinion is of the different geographies with respect to private markets. So you know, I think we discussed some of these, right? The fact, you know, why is Africa less favored, or South America? And you can see that that's true if you look at your peers' portfolios. Other large public pension funds in the U.S. Don't have a lot of representation from those two geographies in their portfolios. And I think, you know, it's because of if you're looking at how relatively attractive it is to invest in South America or Africa, to Europe and North America, developed markets, but even to Asia. You know, again, if you were force ranking them, right, and you say, well, US would be your first choice, Europe second, Asia third, and then you get to Africa and South America. I think the reason South America has some representation in these portfolios compared to Africa, which is close to zero, is that the private equity and generally private markets, because also private infrastructure, private debt, and private real estate in South America is been an industry that has been growing for the last 20, 25 years. So over that period of time, certain winners have emerged, and a lot of experienced people are now in the ecosystem. So there are more opportunities within private markets there. I think Africa is behind in that maturation curve, but coming along. So more opportunities will be available. So really, I mean, Those were all the remarks we had. So again, open it up to questions and comments.
Yeah, some observation, in particular South America. That's I'm sure you expected that from me. But when we're looking at a continent, just like we're doing in Africa, but as we all know, continents have different countries, different economies, different GDP growth. So my question, Mr. Fernandez, is with regards to South America. Are we looking at the Pacific aligned countries and in addition to Brazil, or are we lumping everybody, all these different countries in this chart? And the same thing with Africa. I mean, in Africa, you find some countries that are more advanced than others. Consequently, that represents higher opportunity. So,
yeah. So the large economies tend to have the most opportunities, right? So within South America, it's Brazil, obviously largest economy in Latin America. This is South America, but if we include Mexico, that's the second largest economy. Those two countries have country-specific funds that are institutional quality funds, and we do look at them. Colombia, third largest economy, also has country-specific funds that we have looked at and continue to look at. As you go to the other countries, there are more regional funds that are investing across the entire region. That tends to be true for Africa as well, because Africa, country-specific funds, you really only find in South Africa and Nigeria. The rest of the countries, the investments are coming from regional funds, whether they're based in South Africa or London, as we talked about, or some in Switzerland. They tend to be regional investment funds. And also tend to, some of them more, not just focus on one region like Africa or South America, but focus on emerging markets generally. So there are a few funds that invest across all the emerging markets, Africa, South America, and some of the Asian countries, the less developed Asian countries. So those are the three types of funds you can find, sort of the regional within a specific region, the multi-regional ones, and then the country-specific ones. I think for country-specific within private markets, you want to stay to the large economies. I think in South America, that means Brazil, Colombia, again, Mexico, if you go north of South America. And for the rest, you would look at regional funds that are investing across all the regions. And the same in Africa, you would be looking at country-specific South Africa or Nigeria, and then regional funds for the rest of the region.
The only thing I'd add to what Jose was saying is that it's worth remembering in something like an asset class like real assets, infrastructure, etc., you may well find you have more regional exposure outside the US to capture that asset class. So less of a case of thinking about it just geographically, but where would I get my access to timber or something like that? That would actually find, or mining, etc. You'd find yourself in different geographies around the world.
A question, Jose, maybe it's appropriate too that this reminds me of the game Twister, looking at all these colored dots. I guess that makes sense. But I've asked before about, the looking through the lens of COVID at certain things. How much of this would change in your mind, with or without COVID? Because I know Africa in particular is going to be lagging in terms of vaccination rates. I've read, for several years. So does that deepen the red, in some of these categories? Does that cause concern in areas of South America as well?
Interesting question, because I think my answer would have been different 3 or 4 months ago than today. I think the vaccination, the availability of vaccines, has been greatly expanded. And I think these countries in South America and Africa are finding that when they thought maybe 4 or 5 months ago that it was going to be very hard for them to obtain enough vaccines for the population, that now they're much more optimistic about it. Specifically talking about Brazil, I was talking to our office in Brazil this morning. I think the Brazil in the large cities like Sao Paulo, I think is now over 50% of the population is vaccinated. People are starting to come back to the office because they're vaccinated. Where again, at the beginning of the year, they thought to get to 50% vaccination in Sao Paulo was not going to happen this year. It's already happened. So I think that's very positive news with respect to that. So, does that make it more red? I mean, I think it's clearly something we have to watch. And of course, we don't know about how COVID may change and evolve. And it has been, devastating, to the whole world, but particularly, poorer countries, right? So, yeah, it's something we look at. On the other hand, it has also, ushered in advancements that we didn't think about before, right? Some of the technological advancements, some of these opportunities for some companies in these countries to be noticed outside, because now they can provide services virtually, whereas before they might not have thought about it. So it also creates opportunities, or has created opportunities, that I think help these economies.
Yeah, just anecdotally, also on the COVID effect, just say from investors, the feeling that it's flattened the world a bit, because you are doing things virtually. It makes it that little bit easier, because you don't feel as if you have to jump on an airplane and go there. And as long as you've got consultants or people you can work with who are there, who can do the knocking on the door part, then people are feeling a little bit more able to spread their wings and be a bit more geographically diversified.
Yeah, I agree with that. I'm amazed of the progress that Colombia has made with the vaccination. All my relatives, including my 12-year-old nephews, are fully vaccinated in Bogota. So it's just amazing how these countries, even though they're emerging and small, have been able to get the population vaccinated. So it's just fantastic, and I suspect that in Africa it's the same thing.
So hearing a bit of a pause, if there are no other questions on geography, we can go to the conclusion, and I'll be fast. If that's, and I see a couple of smiles with kind of, so on 73, this basically just is what we discussed. We went through the 5 components of our strategic initiatives, and the points that are on this, we were somewhat presumptive, and we just put down some of the aspirational topics, the discussion points. We certainly have a lot. We've discussed a lot, and we will review everything and come back to the board. There are a bunch of takeaways, and hopefully my realistic goal is that this will all be reflected in the work plan that we put in front of the board in January. So I think that's a realistic time frame. And then we can have subsequent discussions based upon that. But I think given that we have the TIDE presentation, AB 2833, and some other things, I think January is realistic. Going to the next slide. This slide says progress and considerations towards best in class. I'm a big fan of the phrase best in class. The top part, the speedometers of sort, represent the acceleration that we've had since 2018. I think we have made progress in every dimension for all the initiatives in Allocator to best in class investor. I think the last 2 discussions post-lunch where Makita, Alborn, and Stepstone help put some light on be it geographic exposures and peer positioning, really are the second part of the title to this slide, considerations, things that we will weave in and think about as we come back to the board in January. And then the last slide is, and I hope everyone noticed that the slope got even steeper in terms of our North Star at the very end of this, of that being best in class. I think that today's discussion, maybe I've got a lot of horses in this race, but I thought was a really great discussion. I think a virtual, I think all of us deserve kind of a pat on the back in the sense that a virtual offsite to get engagement, to probe one another, to push, is a really difficult thing. So I thank everyone on behalf of staff here. I thank the board for engaging, for pushing us, and for having a really robust discussion. As I've mentioned, we'll attract themes, incorporate this input, as well as anything else that happens over the next couple of months into next year's work plan. That will all go into LACERA's strategic planning efforts. And maybe the last thought that I will have is, what's clear to me is that all of us are aspirational, and that being best in class is important, but we're doing it for the right reason, because all of us truly value the mission that we have towards our members. So with that, Mr. Chair, thank you very much. Thank you all trustees. Nice
job, John.
Yeah, on behalf of everyone, John, I certainly thank you to you and your team. I know a lot of effort went into preparing the presentations today, and our external partners that presented as well. Really good information. Appreciate everybody's time today. Any final comments, questions before I ask for a motion to adjourn?
Go Dodgers.
Go Dodgers. Thank you. I'll second that. Great.
Go Red Sox.
Right, we'll have one Red Sox.
Two Red Sox.
All right. How about a motion to adjourn before we talk about the Red Sox?
Motion to adjourn.
Thank you, Mr. Jones. Take care, everybody.
All right.
Bye.
Take care.